Well, it's been a strong start to the year, but as we look to wrap up the first half, what can we expect in the second part of the year? Chris brought some charts. Chris.
Yeah, we brought a couple charts to talk about maybe what's in store the second half of the year. You know, it's been an unusual first 6 months in the context of, while there's a lot that looks very early cycle, whether that's discretionary or industrials or home builders, there's also a lot that suggests we're still in the same old cycle, whether inverted yield curve. So we went back and we looked, what were the largest rallies ever with an inverted curve? And there were two big outliers. 1979 had about a 30% rally with an inverted curve, and mid-06 to mid-07, I think a period we remember well, also about a 30% rally with an inverted curve. So put 30% on last October's low, gets you about 4,500, 4,550. So you start thinking about maybe as that as kind of the top end of the range here. When you kind of go chart by chart here, I think the bright spot, at least recently, to enter the fold is the inclusion of the transports. They had basically been absent for much of the last 6 months. We just talked about the airlines. Some of the trucks have woken up here. FedEx good, UPS not so much, but I think on balance, the improvement of the transports is certainly welcome. And maybe it's the fact that crude continues to trade so poorly is the reason we're getting airlines and transports and consumer involved here, because the crude chart looks absolutely terrible. I think that's a big missing piece of kind of the new cycle secular bull story. Typically, crude's involved on that. This is the fifth time now that oil's testing this $65, $67 range. I don't know of many quintuple bottoms in my career. So my guess is that does not hold. But two things I think we've got to watch for the second half of the year. One is credit. It quietly has not kept pace with equities the last few weeks here. JNK is what we're looking at here. Actually closed below the 200-day moving average on Friday. It's bounced a little bit the last several days, but I think very important as a barometer moving forward. And then, as Dan said earlier, the banks have largely not been involved here, and the brokers in particular. Not many examples of a market going up much further when Goldman and Morgan Stanley and Bank of America are not involved. Here's the Goldman chart, certainly one of the softer ones there. So there's certainly things to like with transports, discretionary, and industrials, but we got to be mindful. Curve, oil, credit looks a little bit more end of cycle than new cycle.
So in the past 30% rallies in 79 and 05, 06,
mid-06 to mid-07.
Mid-06 to 07. Did we have all of these different things working? Or were there always things that didn't work?
It's never a puzzle that fits together perfectly. I think we've all been doing that long enough to know. What I remember so distinctly, particularly in spring and summer of 07, was how disparate all the messages were. Rates surged in summer of 07. Transports actually started to work. You got another big gasp in energy. At the same time, you were losing stuff like housing and consumers. So you got these very disparate messages. It reminds me a little bit of a couple of weeks ago with that payroll report, right, where we did 300 on the payrolls and negative 300 on the household survey. These very, very divergent data. You actually tend to see that later cycle. So it feels familiar in that respect, Mel.
It's interesting that he mentions 06, 07. Remember some of the dialogue. I mean, we started doing this show in 07, as you know, and some of the dialogue was equally very hard to figure out, delayed, a lot of cross currents, just like we're seeing now. Then subsequently it happened. This yield curve, by the way, now inverted for 15 or so months, 16 months at levels we haven't seen in 40-odd years. People will say it's not a big deal this time. I couldn't disagree with that more. I think it's actually a bigger deal this time, because the move from, again, 110 down to 40, back to 1%, it's not stopping here. And at a certain point, I believe that's going to affect the credit markets in the form of JNK or HYG and subsequently the equity markets.